I've had conversations with people who thought they had retirement perfectly dialed in. They're proud of their Roth IRAs, and they should be. After all, they've spent years contributing, doing those conversions, building a pool of money that they believed would be protected from taxes for the rest of their life. But then something happened that they never expected. A rollover mistake, a timing mistake, a 5-year rule they didn't even know existed. And suddenly, part of their Roth, the account that they assumed was fully tax-free, wasn't tax-free anymore. What is painful that this didn't happen because they did something that was reckless. It happened because they didn't even know about one specific IRS trigger that can quietly wipe out the tax-free protection most people count on in retirement. And here's the truth. Most retirees never even heard about this trigger. Most advisors don't bring it up early enough, and most people don't learn about it until it's way too late. Usually when they get a letter from the IRS or their CPA calls with a surprise tax bill, or their inherited IRA distribution doesn't work out the way they were told it would. The Roth IRA can be one of the most powerful tools in your entire retirement plan, but only if you know how to protect it. One wrong move, even a simple clerical mistake, can undo years of tax-free growth that you worked so hard to build. Hi, I'm Mark Wisniewski, President of Southern Incomes. If you find this helpful, go ahead and like and subscribe. And if you want help building a retirement tax strategy that avoids unnecessary mistakes, you can book a time with me using a link in the description. Now, let's break down the hidden Roth trigger that can unravel your tax-free growth and what you can do now to make sure you avoid it. 1. The hidden trigger, mixing Roth and non-Roth money in the wrong way. This is the #1 reason retirees accidentally lose their Roth tax protection. And most people, they didn't even know it was possible. Here's the problem. The IRS sees your retirement in layers. It's not just one Roth IRA to them. It's really made up of your contributions, your conversions, and earnings, and each category has different rules. But when people roll money over, maybe from a 401k, a 403b, a 457, a TSP, or even just another IRA, mistakes can happen, and one small paperwork error can accidentally mix dollars that don't belong together. For example, you might have Roth 401k money and traditional 401k money in the same employer plan. If those dollars don't get separated correctly during the rollover, portions of your Roth can be taxable, even if you thought it wasn't. And here's the worst part. Once the money is mixed incorrectly, you cannot unmix it. You just don't go to the IRS and say, "Oh, excuse me, I want to fix my rollover." That's not going to happen. I've seen situations where someone spent 10, 15 years growing a Roth 401k, moved it into the wrong account during a job change, sometimes into retirement, and suddenly thousands of dollars of earnings were no longer tax protected. It's not malicious, it's not irresponsible, it's just paperwork. Paperwork that really carries big, big consequences if it isn't handled perfectly. This is why people who do it themselves during accumulation often seek guidance during retirement. The stakes get much higher, the rules get stricter and stricter, and the IRS really becomes less forgiving. 2. The second 5-year rule, the one few people even know exists. Almost everyone knows about the main Roth IRA 5-year rule. You need to have a Roth IRA open for at least 5 years before your earnings can be withdrawn tax-free. But here's the surprise. Every time you do a conversion, that conversion has its own 5-year clock, separate from the main one. And it's this second 5-year rule that catches a lot of people off guard. So say you converted $50,000 into a Roth IRA back in 2023. That conversion can't be withdrawn without taxes for 5 years, no matter how old you are. Then let's say you convert another $50,000 in 2025. That money has a separate 5-year clock. In this case, it runs to 2030. And then maybe you do another conversion again in 2027. Now, you have yet another 5-year clock, in this case, that ends in 2032. This is where retirees get into trouble. They do multiple conversions over multiple years. Then they tap their Roth too early, not realizing each conversion must age for 5 years before its earnings become fully tax protected. And here's why this matters. Withdraw the wrong dollars at the wrong time, and the IRS may treat those earnings as taxable income. You didn't really lose your Roth entirely. You didn't violate anything permanently, but what you did is trigger a tax bill, one that you didn't expect and could have been avoided with better timing. 3. The employer plan trap, rolling over to the wrong account. When people retire or change jobs, they usually move their 401k into an IRA, but employer plans often contain multiple types of dollars. Roth 401k, traditional 401k, after-tax contributions, or those company match dollars. And during the rollover, the wrong type of dollar can land in the wrong type of IRA. In that case, the IRS is going to treat it as taxable income. Here's a situation I see more often than you think. The retiree just checks a box to move their whole 401k into an IRA. The administrator sends everything into a traditional IRA, but some of the balance was in a Roth 401k. And just like that, the Roth tax protections are lost. Another common mistake, people use indirect rollovers, meaning the plan sends them the money first and then they deposit it into their IRA. But indirect rollovers come with rules, strict 60-day deadlines, withholding requirements, and once per year limitations. If you deposit anything late, or worse, deposit 401k money into a traditional IRA, part of that money becomes taxable. These issues aren't always visible right away. They usually show up later, often during tax filing, and by then, it's too late to reverse the mistake. 4. The beneficiary trigger. This is the fastest way to lose your tax-free status. Your Roth IRA is tax-free to you, but that doesn't automatically mean your heirs get that same deal. If your beneficiary forms are outdated, mismatched, or just missing altogether, your Roth may end up in probate, converted into the wrong type of inherited account, or forced to be withdrawn way too quickly. And here's the hidden trigger. Inherited Roth IRAs still follow the same 5-year aging rule. So think about it. If you pass away before your Roth IRA has met that 5-year requirement, your beneficiary may owe tax on the earnings if they withdraw it too soon. And for surviving spouses, there's an additional complexity. They need to move their Roth into either a spousal Roth IRA or a properly titled inherited Roth IRA. Move it into the wrong one, and those distributions may be taxed. I've seen cases where a spouse accidentally took a distribution without understanding that 5-year clock. And, of course, the IRS treated it as taxable. The Roth IRA is so powerful, but it's not self-protecting. It needs the right structure, the right beneficiary designations, and of course, the right timing. 5. The IRMAA trigger. It's not a tax, but it sure behaves like one. Here's one retirees rarely think about. Roth conversions, even smart ones, can push your income higher into trigger IRMAA surcharges. That's the income-related Medicare surcharges. IRMAA isn't a tax on paper, but it sure feels like one when you're paying hundreds and hundreds of dollars more per month for Medicare premiums. Some retirees do a large Roth conversion in a single year, thinking it will save them taxes long term. But they don't realize the short-term impact. Higher Medicare Part B premiums, higher Part D premiums, income challenges in that current year. So it doesn't really destroy your Roth, but it sure changes the math behind it. It doesn't mean conversions are bad. That's not the case at all. It does mean they need to be planned strategically, coordinated with Social Security timing, Medicare brackets, your tax brackets, your withdrawal plan, because what looks brilliant on paper can turn into surprise costs if you convert too quickly or too aggressively. Your Roth IRA can be one of the most powerful tools in your retirement plan, but if you don't understand the rules that protect it, you'll wind up with mistakes. A single rollover mistake, an overlooked 5-year clock, or just a poorly designed, a poorly timed conversion can create taxes you never planned for. The good news is, with the right planning, many people find that they can keep their Roth protected and align it with their overall retirement goals. If you want help making sure your Roth strategy supports your income plan instead of complicating it, go ahead and book a time using the link in the description below.